UBS equity research analyst Erika Najarian. Erika, from your coverage universe, just how are you accounting for what may be more expensive cost of funds and lack of a willingness to lend overall? What's the impact going to be on earnings?
Sure. I think there's going to be a pretty significant impact to consensus earnings. So, there are really three things. Number one, even in the before times, before Silicon Valley Bank, the balance sheets were shrinking. The H8 data that Steve Leisman was mentioning, it was already down, 3% in the before times on March 8th. And I think the issues with the banks today are going to exacerbate potentially, some of those deposit issues. And therefore, deposit costs are going to accelerate potentially more significantly than the banks anticipated. And I do believe that even from the beneficiaries of this deposit reallocation, which would be the largest banks that I cover, I think there's going to be some belt tightening heading into recession. So you not only have the impact of lower net interest income generation in terms of consensus adjustments, but we now have to think about higher credit costs as we think about heading into a U.S. recession.
Yeah, credit becomes a lot tighter. What about the regionals overall? The scenario that you're discussing, does it lead to consolidation? Let's assume we get past this crisis of confidence. Where are they looking in terms of their ability to earn money over the next few years?
Look, I think consolidation is an inevitability. And this is why. So even if we get past this acute liquidity stress, at the end of the day, what I think is inevitable as a result of all this, stress is potentially even tighter regulation. And I think the tighter regulation is not going to be just concentrated on the G-SIBs as it has been, but could potentially be dragged down to the regional banks. And in order to fight the ROE dilution from tighter regulation, you're going to have scale, and thereby consolidation could be inevitable.
I just wanted to mention, Erika, two more names. We were all watching First Republic as the next potential domino here. And I know you don't cover the smaller ones, but Comerica and Zions Bancorp are both down 45 to 50% for the month. So what? I mean, that's more than just a re-rating on earnings, isn't it?
So I just want to go back to the Fed data that you put up on your screen. So what the market is pricing into these regional banks is just the fear factor of who is next, right? Who is experiencing acute liquidity stress. The relative good news here is that when you look at the Fed balance sheet, we definitely remain in a high stress situation, but the situation is not getting any worse. So I think that some relief will come at 4:15 today in terms of really seeing what the deposit data flows are telling us. And right now, what the market is sort of pricing in and fearing is we're lacking hard data from the lion's share of regional banks in terms of their individual deposit flows. But the good news is that in terms of, the Fed balance sheet, with the Fed balance sheet, it's telling us it's not getting any worse.